Good afternoon.
Hey, Dwayne, can you hear me?
I can hear you.
Okay.
Hi, Dwayne, we hear you.
Okay, hello. Thank you.
You want to settle on hold? There you go. Then we can see more people than just. Try.
Yep,
It's 1:31.
we're waiting for the mayor.
Really, that's what we do? Okay,
We have a quorum, but
we have a quorum sitting here now? Who's the vice chair? I am? Oh, shoot, let's get started then. I'm the vice chair, that's my role, is to get us started.
that's fine.
The
The agenda's up on the screen.
we'll skip the swearing in of new board member right now. Roll call.
Roll call, yep. Matt Newcomb,
Here.
Scott Nast,
Present.
Mayor Carrera is absent right now. James Norwood
President.
and
Let's see, we just get the election of a new chairperson and tell all the members are present. You should have an opportunity to read the minutes of our last pension board meeting. Is there a motion to either accept or deny?
Make a motion to accept.
Been moved by Matt.
Second.
Second, is there any discussion? All in favor? Aye. All opposed? Motion carries. Is anybody here to represent Boston?
yes, on the screen is Patrick Donlin.
Okay. Patrick?
Can you guys hear me and see me?
Yes, sir.
Yes, sir.
All right, I mailed valuation reports to you. You guys have them in front of you?
They look like this.
I
Yeah.
have, you have them? So I have good news and bad news in this report. So if you want to go to page 6. So every year, as of October 1st, we look at the assets in the pension plan, and then we project out all the future retirement benefits to get an appropriate funding requirement for the next year. And we always do it 1 year ahead so that the city can budget. So the right-hand column on this page is the valuation as of October 1, 2021, the snapshot. And that determined the requirements for the year we're in right now. And the left-hand column is the snapshot as of 10/1/2022 that determines the funding requirements for next year, 9/30/2024. And you can see that the costs actually went down some, which is obviously a good thing for the city. The total required went from 35.1% of payroll to 31.6%. And then if you take away the members and the current state monies, the city goes from about 23% of payroll this year to 19.5% of payroll for next year. And part of the reason that it went down is the bad news that I have in this report. And that's the state monies. Most of you guys remember that in this plan, everybody gets the same employees as the general employees, same benefits. And then we use the excess state monies to provide an additional multiplier for the police officers. And so if you go to page 8, so the year last year, we had went up from like 0.6 in that chapter 185 monies to 0.65 when we did the 10/1/2021 valuation. And that was because we had a great investment year in fiscal 2021. And then this year we had a terrible investment year in 2022. So now the state monies, now the extra multiplier had to go down to 0.55. So in the end, right now the members are getting a 3.15 multiplier. And then starting 10/1/2023, it'll go to 3.05. And the reason is because the calculation looks at all of the excess state monies that we've ever received and compares that to the extra benefits we've paid the police officers. But it all gets earnings, it gets earnings at whatever the plan gets. So that accumulation of prior excess state monies, when we applied that negative return this year, we have less money to provide extra benefits for the police officers. Does that make sense?
Makes sense, but it's not good.
Yeah, no, I agree. I wish I had better news on that front. But so if you want to look at the asset part of it, that's on page 31. So towards the middle of the page, it says last year we had $13.7 million in the plan, and we expected to get 7.5% earnings. So the expected investment earnings, like the third line down on the development of investment gain or loss, it says $1,012,000. So we expected to earn $1 million on that 13.7 million. And the actual earnings were a negative 2.2 million because we got a negative 16.46% return for fiscal 2022. And so the gain or loss relative to what we expected was 3,227,000. We missed the mark by 3.2 million. So then in the upper left-hand corner, we started a new smoothing technique a couple of years ago. And basically every year, we just recognize 20% of the gain or loss. So that $3.2 million loss for actuarial valuation purposes, for funding valuation, we're only recognizing 645,000 of it. And then next year, we'll recognize another 645 of that loss. But 2021, remember I just mentioned we had a great year that year. So we're recognizing 20% of that gain each year for the next 4 years. So, in the end, we ended up with a loss on the actuarial basis using the smoothing of 282,000. But for the 1 year, it was really a loss of 3.2 million. So I just want to warn you that, absent anything else, just on the investment side, we're going to have increasing costs for the next 4 years because of that loss that we had this year. Does anybody have any questions about that asset smoothing? And we've never done asset smoothing on the state monies issue. And I'll think about if there's a way that we can start doing that next year. Because like I said, 2021, we told the members the multiplier can go up because we had a great year. In 2022, we said it had to go down because we had a bad year. So I will look at if we can start smoothing, starting next year. And hopefully that'll make so we don't go up and down every year on that multiplier for the members. So then if you go to page 38, that's the turnover. And as seems to be the case a lot of times there at the Palatka Police Department, you did have quite a bit of turnover. So at the top of the page, as of 10/1/2021, you had 26 non-drop police officers and 2 people in the drop. And then you had 1 person that terminated non-vested and they just hadn't yet gotten a refund of their contributions. And then you had 9 people that terminated and did get a refund of their contributions. So out of the 26 members, you had 10 of them terminate non-vested, which is more than we expect. So that was an actuarial gain there. And then at the bottom, then you hired 5 new police officers. So you actually had 26 plus the 2 in the drop as of 10/1/2021, and you only had 21 plus the 2 in the drop as of October 1, 2022. So was that maybe just you were still trying to fill positions? Do you guys normally have more like 28 people in the department?
No, we're slated for 32 sworn in the sworn region, but we do have positions open right now.
Yeah. So, next year, your payroll will probably be higher because you'll fill those positions. And that might actually bring the contribution requirements down slightly because we have that payment to amortize the unfunded. And so we divide that mortgage payment by the payroll. So, that might actually help a little bit in the funding requirements if more people are hired by 10/1/2023. At the bottom of the page, obviously a great thing for the police officers and the retirees, you had no mortality, but that produces a little bit of an actuarial loss because we just have to keep paying all the retirees. Then if you go to page 48, so this is the accounting of the plan, and the city has to put a liability on their balance sheet for the pension plan. That's called the net pension liability. And there you take the market value of assets compared to the accrued liabilities. So there in the accounting, we can't smooth the assets. So at the bottom, you can see the net pension liability last year was $536,000. This year it's $3,586,000. So it went up about $3 million, which if you remember was basically equal to the investment loss, on a non-smoothing basis. I'm pulling up last year's report because I'll bet you had the opposite experience last year.
I guess my page is not.
Yeah.
Move again.
What'd you say?
My page is not remembered. Okay, I'm doing that.
So last year it was 10/1/2020, it was 1,625,000. So it went down in 2021 and then back up in 2022. But that's just the nature of not being able to smooth the assets for the accounting purposes. So then I'll make you go back towards the beginning of the report and go to page 18. So this is for funding that develops the funding requirements we saw at the beginning on page 6, and that uses the smoothed assets. So last year, the unfunded actuarial accrued liability was $1,815,000, and we make a payment each year to pay that down. So we expected it to go to $1,685,000, and in the end, it was $1,682,000. And you can see where the gains and losses came from. But the investment return using the smoothing, remember, was a loss of $282,000. And then salary increases, individual salary increases were higher than we expected. You guys probably got salary increases October 1, 2021, because this looks at your fiscal 2022 salaries compared to your fiscal 2021 salaries. And so, if everybody gets bigger than expected salary increases, then their projected benefits at retirement go up. They're more than we expected before because your benefits are based upon your final average salary. So that was a loss of $557,000. But then you had that high turnover, 10 of your officers left non-vested. And so that was a gain of $523,000. So overall, your actuarial loss was $447,000, but then making that reduction to the multiplier was a gain of $466,000. So that's why you ended up at $1,682,000. So I only have 2 more pages left to show you, and that's page 13. So the top line on page 13 is the normal cost of benefits accruing every year based on our assumptions. And that usually stays pretty stable. It went from 16.4 to 16.6, but it is based on our assumptions. And you guys approved making several assumption changes in this report. And so those assumption changes reduced the normal cost from 16.6 to 13.3. And then with the new multiplier, it goes to 13.0. And then the administrative expenses, that's our fees and Bonnie's fees and all that, or Anna's fees. So that went from 2.6 to 2.8% of payroll. And then the payment required to amortize the unfunded, that's that mortgage payment for that unfunded actuarial accrued liability. And that went from 16.1 to 19.4 because we had the actuarial losses, but then it went down when we did the multiplier reduction. So it went from 16.1 last year to 15.8 this year. So when you add those 3 pieces together, that gets you that total funding requirement that went from 35.1% of payroll to 31.6% of payroll. The last page I was going to show is page 11, because that has your funded ratio, and that uses the smoothed value of assets compared to the accrued liability. And this is where plans are trying to be in that 80 to 100% range. And you guys went from 87.4 last year to 88.4% this year. So the plan is healthy. We just had that, that poor investment return this year. But other than that, the plan is healthy. So that was the highlights that I wanted to go over, but I'd be happy to answer any questions anyone has.
Any questions? Is there a motion to accept the Boston report?
Make a motion to accept the report. Second.
It's been moved and second that we accept the Boston report. Is there any discussion? All in favor?
Aye.
All opposed? Motion carried. Welcome, Mayor. Yes. Okay. Is who gonna do swearing?
The city clerk has said, she checked with Valeria, the city attorney, that the new mayor does not have to be sworn in because she's been sworn in as new mayor and it's going to cover all boards.
Okay. All right. Election of a new chairperson.
Yes, Mayor Held was the chairperson
Mhm.
and we need to elect someone else. I believe Captain Newcomb is a secretary. And Mr. Norwood is the vice chair. So we just need a chair between.
I move that the Mayor Korea be the chair of the Police Pension Board.
She was kind of hoping she'd learn a little more before.
I mean, that's always been the role that the,
Okay,
that
I
we've all
get
give that honor to, so. Is that second?
A second.
Well, I guess if I'm the one conducting, I can't make the motion,
You cannot.
so somebody. Oh,
I motion that the mayor is elected as the chairman of the board.
Second.
It's been moved and properly second that the mayor is elected as the chair of the board. Is there any discussion? All in favor?
Aye.
Ayes have it, motion carries. Mr. Mayor, we turn the gavel over to you. Ms. Mayor, I'm sorry, we turn the gavel over to you.
Thank you, I think.
And we're at item 6.
Okay. Capital City Trust Report. Wayne Madra.
Yes, hello, this is Dwayne Madron in Tallahassee. Good afternoon. I guess everybody can hear me. I guess, Jill, you're going to put up the investment report on the screen. And I hope they have a copy in front of them.
Okay, one. We're gonna have to get Dwayne, if you can wait a moment, I need Sonny to come in here because it didn't come up.
You want me to start?
Yeah.
I'm sorry, Mayor, that's the wrong thing. That's what she had to do. Yeah,
Bottom up, it is one. And I don't know how to do it. There's the report on the USB, but it didn't transfer over when we shared.
Yeah, let's show it.
Now they'll be able to see it.
Now you have to just open it.
Okay. Thank you. Right. Okay, Dwayne, we have the report up.
I think that's on.
Oh.
That's very good.
We need the capital city to.
No, I don't have it, and I don't know why, but I don't have it in there on my thumb drive. But all of the board members have a copy of it in front of them. You do not.
It's not here.
None of them have it. They now all have a copy of your report.
They do have it.
They do have it.
Okay, I'll go ahead and start. So the report in front of you looks like this with the blue bar on the front, and the first page inside would be the policy review of the plan for the equity. And for the total plan, we manage the equity portion, just as a reminder. So if you look at the policy review, we have some columns of numbers. And there's a column that says percentage of market value, and then there's the policy percentage, and all of the actual percentages are within range of the policy, and you see the operating ranges out to the right. So you'll notice that large cap and international equity are below their policy percentage, as is infrastructure. And that is to make room for private real estate, which is recently added. And so for that reason, I'm underweighting large cap and international, and small cap and mid cap are pretty much neutral. And because a lot of the tech names are in large cap, I preferred to stay a little bit underweight. And then international is having a challenge with emerging markets where China was locked down due to COVID. And so for those reasons and for their slowing economies, I kept large cap and international a little bit underweight, but eventually we'll be equal weight all of these when things calm down a little bit. You can see where bonds are overweight because I believe bonds have a lower downside than do equities. Bonds are actually cheap. Equities may be still a little bit expensive in certain areas. So I don't mind holding a little bit more bonds than normal. And by the way, cash here at the trust company is now paying, as of today, 4.3. So it doesn't hurt to be a little bit overweight in cash, which I am, and that's dry powder for a rainy day. So still trying to stay close to Burgess Chambers model. It does well in up markets. It's geared to be offensive, and we've seen it in up markets do well, and we've seen in down markets where it lags a little bit. So just to recap the fourth quarter of last year, it was a better quarter because October and November were positive months. Actually, inflation was starting to get under control, and that lifted spirits. But then December rolled around and people noticed, hey, the economy is slowing down. And that could mean a recession. So December ended up being a bad month because of the slowing economy, not because necessarily of inflation. So we ended the quarter, if you turn to the performance page on page 4, where there's a green pie chart, it looks like this, green and blue and yellow and red. So this is through December. And the year-to-date number, by the way, is the fiscal year-to-date. So fiscal year-to-date, we're off to a good start at 7.82% on the equity side. On the equities that I manage, the actual equity was up 8.49 in the fourth quarter, off to a terrific start, beating the S&P 500 because of the outperformance of international and mid cap. Bonds, which are high yield bonds, were up 5.37 first fiscal quarter, beating the Bloomberg aggregate because high yield bonds do better when bonds are coming back. And as bonds came back, high yield outperformed as it normally does because it tends to be an offensive bond category. Real estate's coming back 4.39 in the quarter, and cash return 0.71 for the quarter. But that'll eventually, that number will be 4 as time goes on. So off to a good start in the first fiscal quarter. January was a terrific month. If you turn the page to page 5, you can see how things change, where the year-to-date was 7.8. Now the year-to-date at the end of January is 15.4. January was a great month for equities, where it returned about 6 to 7%, depending on how you define equities. Bonds were up 8.44, had a great month of January, where they earned about 4% on the average. And then real estate year to date, this fiscal year to date is up 15.2. So year to date through January, 15.4%. Of course, the year's not over, and February has been a pullback. February is having a difficult time because inflation resurfaced, and people don't like that because as he's raising rates, Jerome Powell is expecting inflation to come down. Well, the last report that came out, inflation is going the other way. So now we're not sure how many more times Jerome Powell is going to raise rates. And that's sort of the big elephant in the room at this point. Any questions so far?
Have the feds identified why inflation is going in the other direction? Rather than, they're constantly raising rates. And that normally slows down the economy and also it normally. And let's slow it down to a point to where it stops. It slows it down to a point where it's manageable. And if he's raising rates and the inflation is still going in the opposite direction, there has to be something else that's affecting that. We know what that something else is.
You're asking what is affecting, why is inflation going up?
Why is it going up? Even, the feds continue to raise rates in order to control it, but now it's going in the opposite direction. Is there a reason for that?
Yes, wages are going up because we have an economy of full employment and people are demanding higher wages. They're changing jobs. In certain industries, wages have been going up. But in addition, the service inflation, everything from healthcare to haircuts to travel, the service industry inflation is going up. And I don't know exactly why that is, unless there's pent-up demand and higher income people are moving around and spending money. But he's trying to choke aggregate demand, and in some cases it's working. Some companies are slowing down hiring or laying people off, where other companies are ramping up hiring. It's a weird economy. Some industries are doing well and some are not. But the core inflation, which takes out food and energy, which is rents, healthcare, like I said, service industry, hotels, lodging, that's been the problem. Even housing has slowed down. But why is it still going up in aggregate? And he may tell you, he being Jerome Powell, that it takes time for policies to take effect, sometimes 18 months after he makes a decision. So he's saying that I expect it to work, but it hasn't worked yet. So every month he talks about how much more do we have to do to see the effects of it. We see it coming down if you look at inflation over 12 months, as a bad month rolls off and a good month rolls on, inflation looks better. So as those bad months from last year roll off on the 12-month rolling, you'll see inflation look better. So it may be that the bad months are still stuck in the 12-month average. But it's certainly is not completely under control. Parts of it is, parts of it are not.
Well, it's the 14th month, so. Let's see. Thanks, sir.
So the rest of the report is the asset allocation, page 7, which talks about as of February 14th, the amount that's in the equities that I manage, which is 10,623,669, and equities are at 62.8%. And if you add real estate to that and call that equity, it's closer to 70. So we're getting up to where the equities are a hefty part of the plan. If you turn to the rest of the pages, page 8 and page 9, you see the mutual funds that we use, all low cost index funds for the most part. And you'll see the Sawgrass amount on page 9. And you'll see the high yield bonds on page 9, which are, by the way, yielding 5.2. And you see the real estate down at the bottom, which is yields 3.5. Remember, real estate is there as a diversifier against bonds. So when bonds have a bad time, real estate usually does better. So a moderate growth portfolio. I'm keeping equities up because we're hopefully getting to the end of this rate increase regime. Maybe by May it'll be over. And we've seen January earnings come out to be mostly good. A few companies reported soft demand, but I didn't see where there was a major problem to go running and hiding from equities. So I pretty much left equities alone and let's let it float up. And throughout the year, if I have the opportunity to buy on dips, like about right now, because the market's pulled back about 6%, I'll do it. So that's the name of the game, is try and, buy equities on the dip, get that 4% yield from bonds, and hopefully we can reach that 7% actuarial return. That's all I have.
Thank you.
Thank you.
Do we have a motion to approve the report as provided?
Motion that we accept the capital city report as presented.
Second.
So moved. Any discussion? No discussion. All in favor? Aye. Thank you. Next is the BCA report from Mitchell Brennan.
Thank you for having me. I also passed out just an additional handout. Obviously, 2022 was a pretty unique year, so I want to add a little additional context to it. So I'll first be going over this market overview and executive summary, and then jump into our fourth quarter report. So on page 2, what made 2022 especially painful is in years when we see equity markets pull back, especially to the extent we saw last year at the lows, the S&P 500 was down about 25% and finished the year down about 19%. What softens the blow in most of those years is bonds. They're the insurance in our portfolio. They provide us with that income and safety net when equity markets pull back. Well, unfortunately, what you see on page 2, this goes back to the inception of the Bloomberg US Aggregate Bond Index. So that's the index we use for Sawgrass, our core bond portfolio. And going back to 1976, we've only seen bonds lose money 4 times prior to last year, the most of which bonds were down about 3%. Last year, you can see in the far right, that bar pointing all the way down. We actually finished the year down 13% in fixed income, which is, again, unheard of. You really have to go back to when they were barely keeping records, the 1700s, to see bond market lose that much money. And again, the reason for that is rates rise, the market value of bonds falls, and the extent that we saw rates rise last year had that adverse impact on bond prices. If you go to page 3, you'll see here, again, just the magnitude of those rate hikes at the far end, that dark gray line. You can see just essentially a straight vertical rise from really Fed funds rate of 0 to 0.25%, all the way up to 4 to 4.25% to finish the year. And then we saw 7 rate hikes last year and an additional rate hike at the end of January of this year. So as of right now, we see markets indicating that they expect the terminal rate. So when the Fed will stop at about 4.25 or 5.25, excuse me. And again, that will depend on the next CPI reading. So as Dwayne mentioned, we had 3 consecutive months, October, November, and December, where we either achieved or fell below what the expected CPI number was. Unfortunately, in January, we came in a little bit hotter than expected. So that's why we started to see, after a fantastic start to the year in January, February start to get into that choppy market environment that we saw in the latter half of last year. And so unfortunately, we've started to see the Fed's work, but the extent of it is yet to play out for the first half of the year. So we typically see a lag of about 6 months from Fed action to the full impact on the economy. And really what's creating this kind of sustained inflation level is a very strong labor market, where we've seen layoffs in a lot of the big tech companies. They had pulled forward so much growth during the pandemic that, we hear 10,000 or 20,000 layoffs. Well, they hired nearly 700,000 through the pandemic. So it's really just a fraction of what they've already grown through the pandemic, which is why we're seeing such a sticky labor market. And in other areas, if we look at the services side of things, we really see job hoarding. They had such trouble hiring people through the pandemic that they're very hesitant to start laying people off and try and get those people back should the economy turn around. So it's a very unique market environment that an economy that we found ourselves in so far. Page 4, just quickly, I'll just highlight again just the magnitude of rate hikes and increases in interest rates. So this is the Treasury yield curve. The bottom, the gray line, that's where we finished 2021. The blue line above that is where we finished 2022. So again, just huge increase in interest rates across the board, whether it's 3-month treasuries all the way out to 30-year treasuries. And while that was painful for 2022, as Dwayne mentioned, it's actually a huge benefit going forward, where in past years to get our assumption rate of upwards of 7.6%, we had to move more of the portfolio into riskier areas of the market. We had to move more into equities because in fixed income, we were only getting maybe 1 to 2% yields. Well, now if you look at page 5, you can see yields on the U.S. aggregate bond index, 4.7%. Investment grade corporates, this is right in the middle of the first column, yield 5.4%. And then high yield in some cases, the further you go down the credit spectrum, nearly 9% yield. So going forward, we can rely much more on fixed income than we had to rely on equities in the past few years. And to Dwayne's point, on the right side of page 5, the risk reward trade-off, now that rates have risen so much, you can see that the impact of another 1% rise is very minimal, especially on the shorter end of the curve. So the 2-year and the 5-year, very minimal impact if we see another 1% rise in interest rates this year. Whereas to the reverse of that, there's speculation that the Fed may have gone too far and have to pivot and start cutting rates if they throw our economy into a recession. If rates fall 1%, you can see the benefit. That's the blue lines there. We could see upwards of 6 to 10% returns in bonds if we were to see the Fed pivot and start cutting rates. So again, that risk reward trade-off, not a lot of downside and some potential strong upside going forward is one of the reasons to Dwayne's point that we think fixed income is pretty favorable right now. The last thing I'll point to on this page, again, just talking about how historically bad bonds were. When we talk about U.S. Treasuries, those are really considered the most conservative, the safest place to invest. Well, if you look at the 30-year Treasury, so right in the middle of the page, the return for 2022, the 30-year Treasury lost over 33% for the year. So again, just a historically bad year for bonds based on how much rates rose throughout the calendar year. Any questions on that?
When I guess when I look at on page When I look at the fixed income,
Mhm.
looks like, and Burgess always told, I guess, always told me to look at things in cycles.
Yes.
But this looks like we're in the most severe, actually, from the report, looks like it's record breaking since '76.
Yes. Mhm.
And looks like also we've had 2 consecutive years, with fixed income, not making, getting the negative as well. And also, looking at this report as well, it looks like the cycle is we ought to be coming out and to be very strong in the next, looks like the next 6 months to a year.
Correct, yeah, so once rates flatten out, or again, if the Fed, throws us into recession and has to pivot and start cutting rates, we could see that bull market return to bonds. So we've seen really a secular bull market in bonds going back well past 1976 as rates have steadily come down. I know if you were looking at like mortgage rates in 1990, they were at 8, 9, 10%. Now, just a year ago, they were barely below 3%. Now they're starting to tick back up. So again, we saw that huge trend downwards as rates fell, bonds performed well. And now we're just starting to see the reverse of that where rates go up. We've lost money in 2022. We're slightly positive so far in 2023. But again, as rates normalize and we're clipping a yield of anywhere from 4, 5, 6%, we can expect those returns, better single-digit returns going forward for bonds.
Looks like we're just trying to whip it. Looks like we're just searching right now for that sweet spot.
Yes, and it's the Fed's mandate right now is price stability. They have 2 mandates: price stability, which is inflation. So they're trying to drive that down to the long-term average of 2%. The last report was at 6.4%. That was the January number. So again, they're going to have to continue to raise rates until they meet inflation. And so the expectation is inflation will come down below 5% before they get up to 6%. So that's why that expectation of the terminal rate is about 5.25 right now. If inflation stays hot, they'll have to continue to raise rates, and we could see a little more pain in fixed income this year. But again, it'll be minimized by how much yields have already come up. So if we're making 4.5% yield on fixed income and we lose 5% market value, we're only down, 0.5%, 1%. So we could see some chop this year, but again, if we get that normalized rate and inflation comes back down, over the long term, we expect bonds to be in that 4 to 6% range going forward. And then on page 6, one of the additional effects of rates rising so much is on the bottom right-hand side, you'll see what our 10-year treasury looks like compared to other 10-year government bonds across the world. We had about a 1.7% advantage in terms of yield. And so that's why we saw in 2022 a huge strengthening of the US dollar. And so you can see that on the left-hand side, we actually peaked in October, the US dollar compared to other global currencies before it started to come down. And so as we started to see inflation come down, we started to see a lessening in the US dollar. And so think of it as when we have higher yields here, foreign investors have to take their currency, sell it to buy US currency so that they can invest in our US treasuries. And so that's why we saw that significant strengthening in the dollar as our US Treasury, which again globally is viewed as a safe haven for assets. As that yield started to tick up, we started to see more investment, especially from foreign investors, into our US Treasuries, and that drove up the US dollar. And then how that pertains to our portfolio going forward. So again, we have 2 investments in international, one of which is the American Fund Euro Pacific. It's an actively managed international mutual fund. And then we have a Vanguard FTSE Developed Markets ETF. So that's an index fund that invests in international. But particularly, I want to key on American funds because about a 20% portion of their portfolio is in emerging markets. And so on page 7, you can just see the difference between valuations of US equities versus international equities. And there's a significant discount specifically with emerging markets. And page 8 just shows that really for the past 3 years with China's zero COVID policy, which they finally started to soften on this year, emerging markets have really just been taken to the woodshed. Last year down 20%, and over the past 3 years down roughly 2.7%. And so we think going forward, if you go to page 9, as these international currencies start to re-strengthen, which we started to see again at the end of the year, starting in October, China's reopening is really going to strengthen those economies, strengthen their currency. And on the back of higher commodity prices, on page 10, you can see across the board, with the exception of a few areas like commodities had significant increases in 2022. These export-based economies within the emerging markets, we think they're going to have some favorable returns going forward as they benefit from the strengthening local currency as well as those higher commodity prices. So page 11, we call this grandma's quilt because it's got all the different asset classes painted all over the place. But historically, again, you mentioned there's cycles to the market. Typically, we see the things that have been unfavored in past years start to slowly creep back up towards the top. And emerging markets is no different. You can see in 2015, the worst performer from an asset category, then going into 2017, the best performer. 2018, again, from the bottom, closer to the top. And then 2021 and 2022, as emerging markets was one of the least favored parts of the market, we could see it as some tailwinds like local currency strengthening and higher commodity prices. As those play out in their economies, we could see emerging markets have a very strong 2023. I'll just quickly bounce to the rest of this because I don't want to waste too much of your time. But if we go to page 14, this just highlights again American Funds Euro Pacific, which about 20% of their portfolio is currently in emerging markets. Again, they've been a very strong performer over the long term. So you can see these are rolling 5-year periods, every one of those dots. So anytime it's above that diagonal line, that's a 5-year period that it's outperformed. So about 90% of the time, it's outperformed on a 5-year basis compared to its benchmark. And we think going into this year, it's got some favorable things working for it, where we could expect some outperformance again. Page 15 just highlights their portfolio. So as I mentioned, about 21% of their portfolio is currently in emerging markets. They have an additional about 9% in other Asian developed markets. And so again, we think those are going to be beneficial going forward. Lastly, page 16, this just highlights their portfolio from a sector standpoint and their top 10 holdings. And so I won't delve into that too much, but again, well-diversified portfolio, and we think they're strongly positioned for a good 2023. Any questions on that before I jump into the quarterly report? All right. So we can flip on to page 5 of our quarterly report. So again, we finished out 2022 with a strong quarter, gained nearly 580,000, 5.3%, and we trailed the benchmark slightly, really just due to a slight underweight to equities, which again had a very strong quarter, and a little bit of an overweight to cash and bonds, where we still had positive returns there, but again, less than the rally that we saw in both domestic and international equities. The top performers for the quarter, both your international funds were the best performers. So that Vanguard FTSE International Index Fund was up nearly 17%. American Funds Euro Pacific was up nearly 14%. Mid-cap was up over 9%. And then your Global Infrastructure Fund, which is about 50% US, 50% international exposure, that was also up over 9% for the quarter. If we pan out to a full 1 year, we're down 2.2 million, or about 15.5%. Over that period, the best performers, again, cash up 1.1%. So in a down market, just holding on to cash was beneficial. And then Cohen & Steers, your Global Infrastructure Fund, was down just 4%. And then the Vanguard High Yield Fund was down just shy of 9%. Further out, if you look at the 3 and 5 year periods, you've had investment gains of 1.2 million and 2.8 million over those periods, outperforming your benchmark over both periods. And then if we look out over the past decade, generated 6.8 million or 6.4% net of investment fees on an annual basis over that time period. And then the last bullet on page 5. So we did allocate, you approved a new IPS in March that allowed for a 10% allocation to private real estate. And so we funded 7% of that in September. About 860,000 was that capital call. And then on page 8, this just highlights again those numbers I went over, so you can see for the quarter in the first column that gain of nearly 580,000, and then the net of fee returns of 5.2%. And then if you go to the far right for the past decade, ending December 2022, 6.8 million in investment gains over that period to offset 3.9 million in distributions over that time period to finish out the quarter at 11,513,000 and an annualized return of 6.4%, again, net of investment fees. Page 9, this highlights the current versus target allocation. So those yellow bars or gold bars, that's our target allocation for our different asset classes. So if you go down the left side, you'll see domestic equity, infrastructure, convertibles, international equity, etc. So those bars indicate, again, the gold is the target allocation that we have, and the blue is our current allocation. So again, slightly underweight domestic equity to finish the year and slightly underweight international equity. Since the recovery in January, those are actually a little bit closer to target. So we're currently at, as of yesterday's market close, just shy of 35% in domestic equity and a little over 12% in international equity. So again, Dwayne's been taking advantage of some of the volatility, and as the market pulls back, he's been reallocating some of that money into both domestic and international equities. Real estate, we're at 7%. And then fixed income, we're just slightly overweight there at 25% compared to the target of 22%. Any questions on that page? Right. And then just lastly, page 12 and 13, this is where we break down all the individual investments in the portfolio. So at the very top, you'll see the total fund, its performance for the quarter, 1 year, 3 year, 5 year, and past 10 years. The first number you see there is the return. The number in parentheses is the ranking compared to other public pension funds. The rankings, because this year was a little bit of a drag, have fallen below the median. So think of the rankings as a golf game. The closer to 1 you get, the better. So unfortunately, just outside the 50th percentile, which we target for, but again, that's based on a tough 1 year period. If we look longer term, you've more often than not been better than the 50th percentile. Looking at returns year to date, you got a little bit of an update from Dwayne, but just to highlight, so you'll see on the left-hand side, Vanguard Institutional Index Fund, it's up about 4% year to date through yesterday. Mid cap up nearly 6%, small cap up nearly 8%. And so we've seen kind of a risk-on trade in markets where the things that sold off the most last year, whether it was growth, whether it was small cap, even some of the more speculative areas of the market like cryptocurrency and Bitcoin, those have been the strongest performers so far year to date. And so again, small cap up nearly 8%, whereas large cap is up about 4%. Currently on a year-to-date period. Global infrastructure is flat. Convertible bonds, those are up about 4.6%. Your international funds are up about 5.5% and 6% on a year-to-date basis. On page 13, your publicly traded real estate, so that's REITs, is up about 4%. Private real estate, we won't get those numbers until after quarter end. Again, those are evaluated on a quarterly basis. And then fixed income, your Sawgrass Core Bond Fund is likely up about 0.5% year to date, and then high yield is up nearly 2%. So again, a very strong start to 2023, and that'll add on to this past quarter, which is the first quarter of your new fiscal year 2020. So one thing I will touch on is, again, we added private real estate for the quarter. Unfortunately, we did see a pullback in private real estate as credit and lending is tightened in the private real estate space. We've seen transaction volume go down. And so if there's no ability to price based on current transactions, we actually saw a revaluation of a lot of properties across the board, most heavily in the office space. So vacancies across office have ticked down to about 20%, or excuse me, yeah, vacancy is about 20%. And again, work from home has, as it was expected to start to dwindle after the lockdowns went away and we got back to more of a normalized environment. Unfortunately, we haven't seen that. And again, in a tight labor market where there's plenty of job openings, employees have more of the leverage than employers. And so they can ask to remain at home or say, I'm going to seek another job because there's, 2 jobs available for every person seeking a job right now. And so with that, we've seen a significant decline in the occupancy of the office space. Your manager, American Realty, they're doing as good as they can. Their office space, their vacancy is only about 17% right now. And then on a total portfolio basis, they're leased up about 92%. So that looks at industrial warehouses, residential multifamily apartment complexes, retail. So that's both malls and grocery anchored strip centers. And then some other properties, some development properties that are also leased up to about 93%. So we think, again, private real estate is a great long-term performer. Unfortunately, we just started to see some revaluation this past quarter, but you can see the index below. That's on page 13, that NCREIF ODCE. You can see again, longer term, 3-year, 5-year, 10-year. We expect a little less returns than that. We expect in the 6 to 8% range, but over the past decade, private real estate has generated about a 10% return over that period. So going forward, after this revaluation, we expect a little bit of choppiness throughout the rest of the year, but longer term returns of that 6 to 8%, which again lines up with our assumption rate of 7.6%. And then I'll pause there to take questions. I know, Mary, you're new to the board, so this is probably a lot to digest. So please feel free to stop me and ask any questions, or happy to follow up afterwards if you think of anything that you'd like to discuss. So with that, I'll open it to any other questions or discussions.
Yeah, except for changes.
Second.
So moved. Any discussion? All in favor?
Aye.
Thank you. Plaza, Kaufman, Jensen, Levinson, Enid Marish.
Hi, everybody. Okay, so I see the first thing on my part of the agenda is the Secure 2.0 Act. This is an update on a new law that came into effect in 2023. So there are some highlighted points for public safety officers, some new exclusions for direct payment requirements, beginning December 31, 2026. So this is a little bit in the future, but it will permit first responders to exclude service-connected disability pension payments from gross income after reaching retirement age. It will eliminate certain additional taxes, and it expands the definition of a qualified public safety employee. It also importantly raises the required minimum distribution age from 72 to 73. And that's effective the first of this year. And then the age is going to increase again to 75 on January 1st, starting 2033. So just some things to keep in mind. The memo does have the text of the entire act if you want to take a deeper look. But this is just sort of a quick update to keep everybody in the loop of what's going on in terms of taxes. This next memo is regarding internal controls. I'm not sure if this information made its way to you, but in November of 2022, there was a longtime administrator from a South Florida pension fund who was arrested and charged with theft of pension fund assets and other related offenses. The board is actually still trying to uncover the extent of that alleged theft. So on the memo are some recommendations to safeguard the pension plan's assets. This isn't required, but sort of a good idea to keep these policies in mind and consider adopting or implementing some or all, to ensure the security of the fund. Some important things in here, ensure that the same person is not authorized to write and sign a check. There shouldn't be one person who is really in charge completely of any one thing. Having others involved will hopefully make it much more difficult for, this sort of theft to occur. So again, just some recommendations, things to keep in mind. If there are any questions about specific policies or practices, I'm happy to go further into it. Another one, just that's important that Jill just scrolled through, is to utilize subscription-based services to perform death checks. It's difficult to know when members or beneficiaries are passing away. So utilizing these will ensure that payments aren't being made, after a beneficiary has passed away, which has happened. And then, once the money's gone, it is really difficult to recoup. So considering some of these things to implement, hopefully before the problem arises, is certainly good practice. Then lastly, and I don't think Burgess is there, and I'm not sure if Mitchell can speak to this. I didn't hear anything back from him in terms of comments that he had on this addendum to the investment policy statement. And this was just to add in the language that we had discussed at the last meeting regarding liability for corporate officers.
Yeah, I don't think Burgess is on the call, but we can follow up with you.
Okay.
I'll confirm with him.
Okay, I think, from what I understand, Jill had already reviewed. It's the exact same language that we was voted on and approved to, be placed into an addendum at the last meeting.
Right.
And Jill, now that we are going to add in the investment policy, do you want me to just add this in there as well?
Yes,
Okay, great. So that'll be done for fire as well.
that's correct.
Okay, not a problem. And that's it from me, unless there are any questions, which I'm happy to address.
Madam Chair, I do have a question.
Sure.
Under the memorandum, maintaining internal controls to protect against fraud.
Mhm.
How do our pension administration align with the recommendations?
I'm sorry, could you repeat? You cut out a little bit, so I missed part of the
Well, I was
question.
asking the question to our administrator.
Oh, okay.
When it comes to maintaining internal controls to protect against fraud, under the recommendations that they made here to us, how do we align currently with those recommendations? Or do we need to go by line to see where we're at and to make whatever changes we need to be making in order to align with the recommendations?
I can say that the initiation of a transaction is sometimes me and sometimes Burgess or of an invoice coming in. But anytime a check has to be written, it has to be authorized by the city manager. So he is the second set of eyes on it at this point. And that is each of the funds only accept 2 signatures when it is a movement of funds, movement of money, or a payout. Everything has to have 2 signatures. So that's good. I do not write any checks myself. It's all written by the banks themselves, Cap City or Truist Bank. The one point that I would like is what the attorney mentioned is utilizing a subscription-based service to perform death checks, because although both banks do have go to the Social Security Administration and get the records, those records aren't always right. And we just recently had one police officer retiree who received 3 checks after he was dead. And the family has worked with us to return the money, and it has been returned. But
Which is not, that's not always the case.
that's right.
Yes, so we were, fortunate in that sense. And it is hard to, and I apologize for interrupting, but it is difficult, to stop the payment when you don't know. So whatever resources we have that will update us as soon as possible when someone passes away, the better.
And the opposite has happened too, that the bank has said that someone has passed away. I call them and they're physically there, and they can come in and sign documents for me, with a notary. So Social Security isn't always perfect. Is what I learned. Independent audit, we have the city's auditors perform an audit on the pensions as well. As we get a new finance director, I'm hoping to involve them more in the pension than they have been in the past, so that we have another set of eyes on stuff. But I don't think we're in bad shape looking at these different recommendations.
Madam Chair, I know the administrators stated that we need to properly implement item 5 on this recommendations, where we should utilize a subscription-based service to perform death checks. Can we have you bring that to the board as a action item for us to actually adopt?
Yes. So I can bring you, I'm sure there's a few different companies, so I can get that information and provide that to Jill, so that the board can make a decision on who they want to use going forward.
Thank you.
And the subscription might be for all the pensions, so we could take the costs and divide them among.
Okay, great.
Okay, any further questions? Do we have a motion to approve the report as presented?
I motion to approve the report as it was presented. Second.
Okay, so we move to any discussion. I have any discussion? Okay. All in favor? Aye. Any opposition? Thank you.
Thank you.
On to the quarterly expenditure reports.
So this is the report that just shows what has been taken out of the fund, whether it's pension payments to retirees, the admin expenses for the year. That's $4,000 for an audit. It's in in the budget, but it's like audit, 2250 for liability coverage, $6,000 toward my salary a year. And the rest is mailings, a lot of mailings, because I do an alive and well letter every year to the pensioners that they have to then have a notarized. That's one method that we've incorporated to make sure that we know that the pensioners are alive. And that happens now. We also had to send out multiple letters because every time the health insurance gets changed, I have to contact all the retirees to let them know what the changes are and whether they want to continue. And also their monthly pensions got raised this past year because the actuary, he was discussing that, how they went up in value last year and now they're coming down in value this year. I imagine that increase that they got is going to go away this coming year.
Thank you. Any questions?
I move we approve the expenditures.
Second.
Okay, all in favor?
Aye.
Thank you. I'm going to open the floor up to public comments, but I think there's nobody hanging around for public comments, so we'll close public comment. Other business, on one email address for board members.
Yeah, all board members now have to have a public email. So each of you have been given what the officers already have and you have, but Sunny set you up with an email address that you're supposed to be checking for this Form 1 business from the state. They've had that on the books for a while, but they're starting to enforce it now. So all board members can follow Form 1. There's other business as well, which isn't on here, is that I just found out our June 6th meeting, which is on the books as approved. And we might have to begin the meeting earlier than normal instead of 1:30 at noon time, because there is a building and zoning meeting that starts at 4 here. And in order to get this meeting in and the next one, which is the one that'll start at 3:30 now, the general pension, we have to move everything up so we can be out of here, because we only have one Zoom account for the city.
Chair,
Yes.
we changed the picking time for the June meeting till 12 noon rather than 1:30.
Okay, give a motion.
Motion to accept. Second.
Okay, all in favor?
Aye.
Thank you.
Well. Is there any new business?
Hey, Joe,
Yes, Patrick.
I was just thinking that, every year you have to do that declaration of the expected return for the next year, the next several years, and the long term thereafter. Maybe the board could make that motion today at 7.5%.
Okay, somebody want to make that motion?
It's basically just a busy work thing that the state set up a long time ago, because there was people that had like all of their money in CDs and they would say they were going to get a 8% return. So it's just a dumb exercise, because we look at your investment return assumption all the time. You guys just did an experience study last year, but it's just a formal declaration that the board has to make once a year, and they ask for it on the state annual report. But the motion would just be that, based upon the advice of its consultants, the board expects to earn 7.5% for the next year, the next several years, and the long term thereafter. And if Mitchell's there, maybe he can opine on it also.
Yeah, we certainly think 7.5 is attainable, especially how we started this year and for the longer term. That's our goal. That's the way we established our asset allocation.
Based on our actual recommendation as well as our investment advisors recommendation, we are looking, we estimate that we will have a estimated return of 7.5% for this fiscal year.
Going forward.
Wonderful.
Do we have motion to approve?
Motion to approve.
Second, all in favor? Aye. Any other business?
That's all I had.
Okay. Does anybody want to make a motion to adjourn?
Motion to adjourn.
Okay, second.
Second.
Okay, we are adjourned. Thank you.
Nice to see everybody.
Thank you.
Thank you. Goodbye. See you.